So first, I want to thank Stony Brook Small Business Development Center. Thank you for the opportunity. Everybody that's here, thank you for showing up. I want to make this as informative as I can and keep it simple at the same time. So first things first, I'm Joseph Llanes. My company's Citrus and Gold, and we do restoration, education, and basically help you figure out and fix your credit. Everybody has different circumstances, so while we go through, try to keep your questions basic and brief. And if it's something I think that we have to do more time on than we could do here, we'll get in touch with you later. We'll do a phone call or something. And last but not least, if anybody wants to get in touch with us, information's on the screen, number, email, and we got the website citrusandgoldinc.com. And there you can leave your personal information, and I'll get back to you as soon as I can. So with that being said, welcome to Understanding the Credit Game. The reason I chose that title is because personal credit is kind of like a game, and like any game, if you don't know how to play, you don't know the rules, you can't win. And that's the goal. Everybody wants to win. They want good credit. They want their house. They have their goals, and that's what we're here to do: is to help you achieve your goals. Everybody has different goals, different situations. So here we go. Who is Citrus and Gold? A little bit about me. I did construction for years. While doing the construction business, I had issues with the credit because I had college loans and I didn't have any knowledge about how credit worked. Came out of high school, had no clue, got some cards, went to college, used them up, and after that, I'd never paid attention to it until I needed it later in life. So this is kind of being able to give people that information that I didn't have so they don't make the same mistakes and, run into bad credit at one point in your life because you just didn't know how to play this game that we have. Citrus and Gold, right? After I fixed my own credit, I helped some family members and some friends. And after a little bit of time, I realized I had a little market here that people needed help with, and I was actually pretty good at it. So I started an LLC. And for 2 years or so on the LLC, I've been doing this as a business, and before that, probably another year just helping people out and learning. It's a constant learning thing. When you stop learning, you stop earning. So I'm constantly learning and trying new methods and strategies that work. And believe it or not, you'll find them. Everybody thinks they know everything to know about one thing or another, but you find out new things all the time, especially in this field. So what we do is we try to help people improve their credit, get their scores up, remove derogatories, and basically understand the basics, which we're going to go over the five basic things about your personal credit and how you can control it and remove things that are derogatory, that are what's holding you back in the first place. All right, so what makes up your credit score? You can see the pie graph on the side. The largest thing about credit is what it is it's a way for the banks to judge you. You basically are your credit score. And when the bank looks at your credit score, they're going to determine whether or not you're going to pay back your loan, or if you're a good investment on their end. So that's the basic thing about what your credit score represents. It's your mm, basically it's you. It's your credit score is you and how much the banks will want to loan to you. If you have and keep a good credit score, we all know that you have better interest rates. You open yourself up to different opportunities to use other people's money now to secure a better financial future. By example of you can buy a house with this credit if your credit score is good, as opposed to renting a house, which you're paying someone else's bill and you get nothing in the end except paying someone else's bill. So one goal, obviously, is getting a house, car, but you need a good credit score to do that. Another part of your credit score that's important to know is obviously you go to rent a place if that's your situation right now, and they'll run your credit to see if you're somebody that's going to pay the bills. If you go for a job, they're going to run your credit, especially if you're in the finance industry, because bad credit could lead people to do unethical things because of their financial situation. And then again, you got military applications where you can go into the military, try to get an MOS or a job, and if it needs a higher security clearance, you could be not denied for the same reasons as you would for a job, possibly because you could be ethically, you can make bad decisions because of your situation. So, like I said, your credit score, it's you. When they look at it, they judge you, and you want to try to keep it presentable, to say the least. So there are different credit scoring models out there. Real quick, we have the FICO score, which is what most mortgages use, most cars, but we also have different scoring. They're basically scoring rubrics. So like Credit Karma is Vantage 3.0, or what else? Well, different apps, they all use different scoring systems. Some are cheaper than the others. That's really the main difference. But they all use the same scoring pie that we see on the left. And now, as we go through, I'm going to show you step by step what these 5 pieces of your credit score contain. Okay, so your credit history or payment history is number one, and it's the biggest piece of the pie. So basically, what it does is anytime you have a late or any kind of late repo, bankruptcy, these are all like payment histories. They stay with you for a real long time. The lates in particular, they do the most damage. So you want to always try, or at least I suggest, putting something on minimum auto pay, because if you have a late, it's very difficult to get a late off an open account, and it could stay with you, and you could be trying to get a house or trying to reach a goal, and that late payment is holding you back. But on an open account, it's one of the hardest things for me to, or anybody to try to get rid of. They don't want to take it off of you, literally. So things you would like to ask yourself are, do I have any late payments on any accounts? Are they closed accounts or are they open accounts? And as far as if you do have these lates, can they be removed? That's something we could go over a little more detail if you have that question. But it's really specific to different people for different accounts. So think about that. Notice on your credit report if you have late payments, are they closed or open, and can we remove them? How often are you late? Do you have, I've had clients that have 37 late payments on a mortgage, and then they want to do a refi and they can't do it. And they look at me like, can we get rid of these? And it's like almost next to impossible. That's hard to come back from. So if you nip that in the bud by auto pay or making sure your payments are on time, you can keep your payment history pristine is the most important thing, if you ask me. Between the 30, 60, and 90-day lates, those are basically the more late that you are, the more negative points it takes off. If you have a 90 or 120-day late, they then turn into a charge off where they basically close the account for you. And you could lose up to or maybe more than 100 points for one charge off. If it's fresh, over time, they'll start to grab some point backs from other places. But anything that's over 90 days late, bad problem, it's probably going to be something that's going to haunt you for a while. So the next section, utilization. Your utilization, that is basically how much of your available credit or total credit on your credit cards only, just revolving credit card accounts. How much of that total amount of credit on all your cards are you actually carrying as a balance? So let's say we have 2 cards, each $1,000. That's $2,000 of total credit, and we have between the two of them a balance of $200, which would be 10%. So there you would have a 10% utilization rate out of the $2,000 available. What you want to do with your utilization is this is what basically fluctuates your score month to month more than any other piece of this pie. The only thing that does worse is a late in your payment history. But besides having a late, if you never have a late and your score goes up and down month to month, it's usually Most likely your utilization. So if you carry a higher balance with the same amount of credit available, your score is going to drop. And the less credit you have available and the higher the balance, the more it's going to go. So what you want to do is you want to try to keep those utilization numbers as close to zero as possible. I've had plenty of people ask me over the time I've been doing this, oh, isn't it a good thing to keep a small balance and it shows you're using the credit? Never, ever. If you can, your plan should be to have a zero balance every month, avoiding any kind of fees, any kind of interest. And on top of that, you're going to have your utilization at zero and have the most available credit possible, the most available score on your credit. A high utilization will crush your score. I've had people that had $1,600 in credit card debt, and if they paid that 1,600 bucks, they would get 160 points added to their score, putting them in a great position. And in the same line, I've had people that had $20,000 in available credit, and it would cost them $11,000 to get 15 points because of the way that the score works with the high amount of credit available and the amount of the balance that you show. So the goal is always zero on the credit card when it comes time to for per month. If you plan to spend it on a credit card, it should be in the case that you want to pay it all off at the end of that month. So next section is your length of credit or your credit history. So when you apply and get cards and you're young and you just get your first card, your score probably will go up really quick because you finally have something reporting. So they're basically giving you the points, expecting you to be a good customer. Over time, as we go, after you reach like a few cards, your score is actually going to go down a little bit, um, being that it's all new accounts. It takes about 5 years for a credit card to turn into a mature account, and you get the most points available for that line of credit, meaning the amount of credit that you have, your payment history, utilization, all these contributing factors. After 5 years, you keep that card pristine and keep it open and keep going. It's like a gem. So when you open cards, you want to keep them open. You don't want to close them. If anything, if you decide not to use it, you could put the card in the top drawer and never use it again and try to keep the card open. Sometimes they'll close it on you, but they'll usually send you a letter first, and maybe you can use it, put it back away. But keeping these cards open for as long as possible also helps your score. It makes your score mature, like we would say about the account itself. Your score will mature. It will take less points off when you have negative things happen to you in most cases. And you'll retain your score for longer with mature accounts. If you have a bunch of 2-year-old accounts, your score can fluctuate by utilization a lot more. A late payment will hit you a lot more. I've had some people, 50, 60, 40 points for a late payment, and then others more than 100 sometimes because they have immature accounts. Um, and that's just the way the scoring rubric works for that part of it. And that's roughly 15% of your score. So it's nothing to blow off. It's something to pay attention to. But just don't let the accounts close. If they reach 5 years and you want to close them, that's fine. But the older they get, the more value they have to your credit score. Okay, so credit mix. These are all the things that encompass your score. This one's not so high in the totem pole, but it is important. Your credit mix is what kind of accounts do you have? Like we just mentioned with the last question. Do you have more than one card? Do you have more than just a credit card? Do you have a car loan? Do you have a student loan, credit cards, personal loans, any kind of lending that comes through? They want to see how you deal with all of them. Like, you paid your car off pretty good, but your credit cards are suffering. Or vice versa, you pay your house off really good and your car's not ever paid off. You're going 30 to 60 to 90 days and then making a payment, catching up. So with the credit mix, what your best thing to do is to slowly build different types of credit. You don't want to just jump in and open a bunch of accounts or try to. That doesn't really work so well. One reason is every time we put in an inquiry, which is a request for a line of credit, that takes away points from us. A hard inquiry, or inquiry as they call it, takes anywhere between 8 to 15 points on the average person, depending on your, credit history, length of credit, stuff like that. Different numbers will apply. So what I would suggest is something start small. Get a credit card, use it after a few months. What I do notice about credit cards specifically is if you have a credit card and it's a low balance and you want to, or a low available credit and you want to raise your line of credit, use half or two-thirds of that card. Let's say hypothetically you have a $200 credit card, use 100 and 150 a month, and then at the end of that month, pay the whole thing off. And then the next month, do the same thing. And after about 6 months of that, if they don't offer a higher line of credit, then you can request it. Same thing with different credit mixes. So you get your card, you have it 6 months, you get a line of credit increase. Once you get that line of credit increase, now you might want to think about doing something, maybe a small personal loan, or maybe I wouldn't say just a car loan right away because you want to build up to something like that. You want to be in a position to have the best score so you can have the best interest rates, the lowest payments. Um, but credit mix should always be approached strategically. You should say, okay, I'm here. I want to make this kind of credit next. And you should go in with a plan. You shouldn't just go get 10 credit cards and have them all open, not being used. You should focus on one step at a time. I would say like credit card, personal loan. After the personal loan, that builds pretty much, if you, as long as you have a good history, that'll build your reputation up a little bit where you can go for a car. And then maybe from that point, you'll be ready for something like a house. It's not the only way to do it. Some people have and will do it different ways. It's a steady, safe way, especially if you're young, getting out of high school, to build your credit mix over time. And last thing, if you don't need an account, just don't open accounts willy-nilly. I noticed that bullet point. Yeah, just I've had people just open cards and come back and be like, "Hey, I got 3 new cards." I'm like, "Why'd you do that?" And they're like, "I don't know." And then they lose 30 to 40 points on the credit score, and they're like, "Hey, I don't understand. Why did this happen?" And I'm like, "You did 3 or 4 hard inquiries and you killed your score." That's hard. You got to actually like that takes time to come back. It just doesn't come back right away when those inquiries go out. That's why we do it slow, so we're taking less points. Little over time is better than 50 at once.
Ah, okay.
Then you can recoup over
So,
that few months, you'll recoup those points back little by little with good payment history. And
oh,
it's
so,
a lot safer. All right, last section for the 5 would be new credit. So 10% is new credit. We talked about the hard inquiries, how they cost points and what they're used for. Soft inquiries, those are also, they don't take points off of your credit score, but those are more or less for like when you're doing something with a rental or security on like doing a job interview. If you have to have a background check, they'll do a soft inquiry. But as far as the new accounts, I like to say go slow and steady. You don't want to open a ton up all at once, but it is 10% of your score. So at least every 2 years the most, I like to say every year, try to open up one account. And that's what I mean by strategically, little by little, opening accounts. After a few years, you should be able to have more than one account open, and that'll keep you healthy. Let's just say, you haven't opened a card in 2 years. You might want to go find one, even if it's a secured card, just to open the account, and it'll give you a bump in points if you have a little bit of a length of history having credit previously. That one's pretty simple. It's just be strategic when you open new lines of credit, but you don't want to not do it. After you get where you're at, you want to at least, well, I say once a year. Some people will say two, but every 2 years, every 1 year, open some kind of new account. That helps you stay healthy, keeps your score. How would you say? Just keeps it healthy, gives you a healthy score. Okay, this is one of the all-time questions I get more than anything. What should my credit score be? So rule of thumb is a 700 credit score, you're in good shape. You could do better, 740 is the best interest rates and almost all approvals if you put in for something, as long as you're not going opening too many accounts at once. But a 740 will get you your mortgages, it'll get you your car loans, get you the best interest rates. That's where you want to be. 740 and up. Anything below that, you're kind of going to be paying more in the interest, and you're not going to get approved for certain lines of credits. Definitely not the higher amounts of lines. You're not going to get a mortgage with a 600 or even a 660. The lowest you can get a mortgage at, and this is with high interest and not the best terms, is going to be like a 680. Anything below that, you're probably going to end up calling me. Your mortgage guy is going to send you to someone like me, get your score up. But you really want to be 700 and better. Anywhere around there, you're in good shape, better than most. So real quick, I don't know if you can see it on your screen, but I'll just go over this quickly. So the different amounts you're going to pay depending on what your credit score is, right? So all three of these accounts, bad, fair, or excellent credit, have the same amount, $250,000 mortgage, let's say, right? The down payment is identical. They're all putting down the same 8,750, and their closing costs will vary depending on their scores. The higher the score, the lower the closing cost by percentage. And then here comes the interest rate. So bad credit, you're going to be paying a higher interest rate. Good credit, you're going to be paying a low one, and that it varies, but it's a big number over time. Same thing with monthly payments. If you have bad credit, you're going to be paying a little bit more on your monthly payments, and therefore, same thing, high credit, less cost per month on the payment. Overall, it could cost you tens of thousands of dollars to have a difference in 20 to 40 points from the next person. Again, like we said, your credit score is you get judged on it, and there are repercussions for not being able to play this game and understand these little details. Uh, when you're going to get a house, it's fair to say before you even go and try to put through for any kind of mortgage, just have somebody, whether it be yourself or someone like me, look at your credit report, find out what's on there, because it takes time. It takes time to get a bad credit score. So realistically, it's going to take time to fix anything. So before you go through and try to get pre-approved for a loan or an amount on the house, you want to check your credit and put yourself in a better position to spend less over time, which in this case could be 10, 20, $30,000 less just for a few points on your credit score. And this is just some examples of what happens when you're not so uh, favorable with your credit score. As I said earlier, remember, when it comes to the credit bureaus, you are not a client, you are the product. The banks are their client. The banks want to give you the accounts, make their money off you paying them back. And if you think about it that way, that you're not the client, you'll understand why when you go to remove derogatory accounts, even if it's clear that it's incorrect or they're breaking the law, the Fair Credit Reporting Act, it makes it clear why they're not doing what they're supposed to be doing. And that's why someone like me will design these letters to go over time to escalate the language and to point out when they've repeatedly break the Fair Credit Reporting Act. Fair Credit Reporting Act. There, I am in the middle of putting a class together for that. That's a different topic. It's pretty detailed and it's lawfare type language, so it's not for this class, but you can easily go and look up Fair Credit Reporting Act and get your gist of it online. It's basically your rights as a consumer, and there's more to it than just that, but that's what we use, and that's what we're successful with at removing your derogatories. Any questions on that, contact me later. So while you're going and doing anything, any kind of loan, whether it's a car or a house, whatever it is, it's smart to have a credit monitoring system. This is not like a Credit Karma or not just signing up for Experian or Equifax or TransUnion website. You want something that will put all three of the bureaus in front of you at the same time so you can literally look at your credit reports for each account, each line item right next to each other. So you can find these discrepancies and use that information to get the derogatories off. That's the key to it. That's so when you're going for a loan, credit monitoring, not Credit Karma or Credit Sesame, they don't give you all the line items and details. But you want to look it up every month and see what changes and figure out why you're going up or down and fix those problems or repeat those good things when you do them. Another thing with the credit bureaus, if you have charge-offs or collections. Now, just a lot of people do this, they pay off their charge-off or their collection, and they're like, oh, I paid that off, it's done. Meanwhile, it doesn't mean they're going to remove it from your credit profile. They don't have to remove it because they never agreed that they would. What we do is we tell people when the charge-offs come, we obviously will do it through the mail, regular U.S. Post Office, physical mail, and we'll send them an offer letter for a settlement, and we'll say, hey, I have a $1,500 balance. I can't afford that. I'd like to pay 800. As long as you guys promise to remove this negative account after I pay it. And in most cases, it's a collection company. They pay 10 to 20% on the dollar. So they're still making their money and they'll agree, but you do not pay it until you have a written agreement that they're going to remove it. Because if they don't remove it at that point, then you could go after them for damages, which per instance starts at $1,000. And it's pretty much a home run for a consumer law lawyer that, you have proof, it's right here, all right, payment. And, so never pay collections until you have a promise of deletion. I'm not saying don't pay them because they still can make your life hell. And just because you get it off of your credit report and you didn't pay it, it could come back. It's not that you don't owe the money. If you get it off your report and you don't pay it, that's for a temporary thing to get your score where you need to be to get this mortgage or whatever loan you're trying to do. Just don't pay collections until they agree to take it off your report. Otherwise, they will leave it there and they will not even answer your phone call because they don't care. They have their money. And always do everything through the physical mail. When you do things on their website or online, when you agree to terms and services in their little fine print, you're giving up your rights. You're giving up your rights as far as the law of the Fair Credit Reporting Act. They do it on purpose. You are not the client. You are the product. They want your money. Do it through the mail. Anything through the mail is admissible through court. And when you get, or if you get to the point where you need a lawyer, it'll be a home run case because you have something from the mail. What can you do to get a better score? All right, so another big question. Always make sure that you monitor your credit and try to keep it frozen when you're not going to be using it, and you know that. This way, you don't have to deal with anybody doing fraudulent accounts. I've had people open cell phones and never pay them, and just it shows up one day as a charge off, and it's like I don't even know that number or that account, and it's an unauthorized user just making accounts. But if you keep it locked up, if you freeze it when you know you're not going to be applying for anything, it's the easiest, safest way to you can kind of forget about it because you can't even open an account in your name, regardless if somebody else wants to. Excuse me. Um, Again, like we mentioned before, if you want to have the best score possible, keep your payment history 100% immaculate. Those are the hardest things to get rid of. They do the most damage, especially the first month that you have a late. Put your minimum auto pay for any account that you have. Um, it's the simplest way. You can't mess it up. You can't forget it. That's number one, I think, on everybody's list should be minimum auto pay. You won't run into any problems that way. If you don't have a credit card currently, you can begin building that credit with secured credit cards like we talked about before. So we have them. You can get them through banks. You can get them through regular credit card companies. You can call or text me, and I can give you a few links that I have. There are some that I think are better than others. It really comes down to interest rate, and in some cases, it comes down to like how much do I have $1,000? I can't do $1,000 minimum, so maybe you want to go for one of these cards that has a lower amount but not as many perks. But between the perks and the interest rate, those are the two big things that you want to look for in these cards when you're first starting out. And again, make sure you pay everything off before the statement date. The statement date we're going to get into, that I believe is the next slide or the one after. Again, if you're already in debt, now this happens a lot as well. People are already in debt. You have stacked up 3 cards. You're over the amount that you could afford to pay that month. Now you're starting to incur interest. And no matter what you pay, it's always the same balance because every month the interest is stacking back on and you're in a hole. What I like to do, I don't encourage anybody to do debt consolidation. You end up some places sometimes it turns into more problems than what it's worth. If you can
Really?
just make yourself a simple budget and do what I call debt stacking, right? So you have your highest balance to your lowest balance. Let's say 3 cards. You have 1,000, 500, and 100. You put all the cards on the minimum payment in your budget, and then you figure out whatever your budget is over the minimums. You take that remainder of your budget, right? And you put it towards the lowest card. When that lowest card is paid off, you take that minimum payment for that card plus all the extra money that you budgeted goes to the next bill. And you keep doing that every month until that one's paid off. Then when that one's paid off, you take both of those minimum payments for the cards you finish paying plus the extra money for everything, and then you stack it on, and it makes it go much quicker as opposed to paying a little bit extra here and there. You never get out of debt with them. You want to close out the slowest ones or the least balance and work your way up with whatever budget you're working with. I can help you with that. That's not too complicated. Just you got to know how much you're willing to spend consistently. And like one more thing, like we discussed before, the become authorized user on somebody's card, just make sure that number one, you're not going to be using the card, you're not going to have access to the funds. So that's something just keep in mind, obviously. And make sure it's somebody that you trust that's going to pay their bills religiously on time, because if they mess up, it hurts you. So just do it only with people you trust. And like I mentioned, people you're related to. Don't go and do some trade line from a guy on TikTok who says, "Hey, I'm going to give you a $20,000 credit line for $200 a month, and your score is going to go up." It's not legal. That's basically the gist of it. So keep it in the family, if you will, when you come to authorized user. But it's a great tool. Do it. Do it for your kids, especially. That's a big plus. All right, next slide. What not to do? Okay, so one of the big things, people they get charge offs. They have collections calling them. They'll call your significant other. They'll call your mom, or they'll call anybody they have the number for trying to collect the debt. Don't communicate with the debt collectors. So when you go into a charge off mode, basically you have a contract with AT&T. You go into charge off. AT&T then takes a charge off, reports it to the IRS as a loss, and they get a tax credit for that loss. Then they take the bill and they sell it to a collection agency for 10 and 20 cents on the dollar. And they say, here, this is yours now. You collect it. Now, technically, you don't have an agreement with that debt collector.
Right.
They do not have a wet signature contract. They don't have any right to collect the debt unless they convince you to pay it, right? So, what I tell people, the simplest way to test, because sometimes if it's an in-house collection or if it's a really like large sum of money, they'll get these extra instruments, the wet signature contract and so on, etc. An invoice is not a contract. So if they send you a copy of an invoice, that's not binding, that's not going to help in court for them.
Oh, really?
But they can use it to trick you.
Yes.
I tell people don't communicate with them on the phone. Basically, you answer the phone, ring, ring. Yes, hello. Yes, I'm looking for Joseph Llanes, this, that. Simply say, any information you have about this account, send to the address on file and hang up the phone. Don't answer, yes, this is Joseph Llanes. Yes, I live at that address. Don't confirm any information because you don't have to. It's a phone call. And what it does is, so on your credit report, you have personal information, right? You have inquiries, your accounts, and you have personal information. Every time you put in for your loan, obviously, you're putting in your name, address, so on, etc. When you put in for that AT&T account and you lived at XY Street in this town, now you moved. This is years ago. You don't live there anymore. There's a charge off. When they go to send you the proof or information to the address on file, they have your old address. So you're never going to receive that. So technically, they have an error and they cannot collect it. But don't give up any information because once you say, oh, yeah, I moved, now I'm on this block, now they put that in your file and now they can send it to the correct address. But by omitting it, don't let them trick you into giving new information. Let them send you whatever they have in the mail. If it comes down to it and they're real serious and they have the right information, you'll get a summons to go to court and you could deal with it that way. And then you could talk about like settlement offers and so on, etc. But just don't talk to them on the phone. Everything through the mail is the safest, easiest way for your records and for legally, just so you don't have to go out of your way to pay more for somebody that doesn't deserve it. When you communicate over the phone or online, like we talked about before, you do waive some rights on certain websites. Each one is a little different, but you definitely don't want to do anything online, email included. You cannot administer that in any kind of court. You can, but it's a lot more difficult. You really want to do everything through the mail. So if it does go to court, you have evidence to fight with. You're not, just at the mercy of whatever whim they have that day. Again, when they call, just send it to the address on file, hang up the phone, let them deal with it from there. That's their job. That's what they do to make money. What not to do again, mentioned it. Don't apply for credit cards or loans during the credit repair process. You don't want to have 3 credit card offers go out. I've had a few people do this and call me, why do I lose 40 points? Because you applied for 3 credit cards and they got approved, but now you lost 40 points. And over time, it takes time to get those back. So I can't just write a letter and get them back quickly when it works. I can't come back from that. That's why we do it slow. And try not to do it if you have a below 700 score. If you have no credit cards or no credit, we'll do this together strategically. I'll try to help you. Whether you're a client or not, I'll advise you what's a good card, what you need to do to build up your profile. Just feel free to call me or email me, or even go to the website and fill out on the bottom of each page. There's a little section for you to fill out so I can contact you. All right, so real quick, I figured I'd describe this. This is so some people have probably heard it's like a rumor, I guess you could call it. Make more than one payment a month and it helps your credit score go up higher. That's not technically true. I don't know, people have heard that, but the amount of payments that you make necessarily doesn't bring your score up. But this is going to explain how that could be something that happens to people and why. So obviously everybody knows you have your due date. right? Your due date, the minimum amount is due. No matter what, make sure on your due date you pay the bare minimum payment. Keep your credit history perfect. Now, that second payment, where some people might see an improvement in their score, that comes from your statement date. So you can see every invoice you get will have your due date and a statement date. What your statement date is, that's the date that this account reports to the credit bureau. After they report whatever is on that account on that day, that's going to stay there until the next statement date, 30 or 31 days later. So let's hypothetically say on the 14th, well, this one's backwards, but let's just say our due date of September 14th would be the previous month's due date. We make a payment of the minimum, and we still have a balance of $300 on 1,000 line of credit. So it's 30% utilization. On the 30th, I usually say 2 days before, because with the weekend it could not register, or it could show up early or late by 2 days either way. So by the 28th of September, statement date on the 30th, I would pay the utilization number down, pay the balance down to zero to get a zero utilization. Otherwise, if you have a score drop, it could be because you have the utilization after the statement date showing, even though you made your payment. Does that follow? Does everybody understand what I mean? So, statement date, due date. The due date, make sure it's a bare minimum of what's necessary to keep it current, so we don't have a late. On your statement date, whatever balance is there on the statement date is going to affect your score for the next cycle until the next statement date. So, rule of thumb is right before you go and put through for a loan, a big loan especially, before the statement date of that account, pay the balance, if not all the way to zero, as close to it as you can, and you'll get a bonus boost in your points. That's how you can do that month to month. You can keep your score the highest possible score by statement date. Just remember, if you pay by the due date and use the card, it's going to reflect the balance of that statement date, not the day you had your due date. Statement date is when they post. If you never had credit, what should you do? First thing you do is look up your credit score, right? Look up your credit report. You can do that on things like Credit Karma, Credit Sesame. They will give you a rough idea. Just remember, they are not your FICO. So your FICO score that you're going to go for the house or the car loan for is usually a difference of between 30 to 40 points different from the, let's say Credit Karma, which is a Vantage score. And you can still use the different scoring rubrics, because if the Vantage number is going to go up for the month, then the FICO is going to go up. So if one's going to go up, the other's going to go up, but the point different might be different. So if you see Credit Karma, you have a 700, and then you go to your FICO and it's a 740, you're like, oh, my score went up. It's like, no, your score's been that score. You're just looking through a different lens or a different rubric with the Vantage. So whichever one you use, it doesn't necessarily, FICO's pretty expensive. That's like 40 to 50 bucks a month for the FICO score, and there's no discounts, no nothing. So a lot of times we use Vantage, which is just as good to show the increase and decrease, but just look up your score, figure out where you're at, and depending on what one you're using, if you need to, ask me and I'll tell you if your FICO is going to be higher or right about the same. But if one goes up, the other goes up. If one goes down, the other goes down. So that's why you're able to still use them. They're just not to the number exact for the FICO. Make a budget for your finances and build a savings, obviously. Savings nowadays isn't what it used to be. Not many people have anything left, but if you make a good budget, you can put away a little bit at a time, and over time that can build up to something you could work with later, whether you use it to do your secure credit card or some other purchase that you want to do, down payment on a house, on a car. Just put yourself in a bit better position. Make sure you budget something for savings and be consistent. Again, open a secure credit card. We talked about that and why. That's going to be big for people with no credit or even bad credit. Sometimes that'll help. start to build your credit. You want to build that good payment history, utilization low, and just be consistent. Use strategic moves. Don't just open a nilly-willy account. Make sure you know what you're going to use it for and what it's going to benefit, how it will benefit your score. Continue doing this for at least 6 months. Basically, open your account, make your payments on time. If it's a secured card, get graduated. Once you get graduated to a regular card, then you either want to increase your limit or maybe put in for another card, another account. That'll give you a higher credit, available credit overall. And once you have another open account, whatever balances you do have, by statistics, the utilization is going to be lower. Even if you don't pay down that balance on the original card, if you have a new line of credit with new credit added, your percentage of usage will go down just because you have a new line of credit. As you're doing the process, building your credit, you'll notice after a few months, your score will plateau. It'll stay where it's at. That's usually where it's time to make an adjustment, open a new account, graduate, get the limit raised on one of your open accounts if you can't get a new account. That's something, again, call me, ask me. I'm more than happy to answer those questions. All right, so same type of idea. What do I do now if I have fair, good credit, anything? Always look up your credit report, find out where you're at. You can notice the bad accounts and the good accounts. That's usually the first step with anybody trying to look towards anything. Always just know what your score is, know what accounts are bad, and what's wrong with them. So using the information that you have highlighted in your letters, you want to have them remove things for inaccuracies. That's the simplest, easiest way when you're trying to remove a negative account, is to see what doesn't match between the three bureaus, pinpoint that item, and basically request it removed for inaccuracies. And then it happens all the time that one bureau will take an account off that needs to come off and the other two will leave it there. But once it's off of one, now the inconsistencies are on every line item. And now you have bigger grounds actually to get them removed off the other two that might have matched, but now they don't because there's nothing in the last column to match for the third bureau. But again, I can explain that to people in more detail. So as we spoke about, if you have a collection and they do send you proof, a wet signature contract or some kind of proof that it's actually your account and that you're liable for it, or they bring you to court with a summons, you always want to try to get a settlement if you can. A lot of times they'll do that on the charge off, but no matter what, you want proof that they will delete it when you pay, even if it's a court and the lawyer and you're making a deal with the lawyer for collections. You need him to send you a pay to delete letter before you'll pay it. And then you guys work out the percentage and the details. Make a budget, build some savings, and figure out how you can make that money work for you. We only have X amount of hours in the week, and if we all just trade money for hours, we're limited to the amount of money we can make. So by building up a savings and then using it, whether you invest with it, you start a business, you do something that can make your money work, you can, in a sense, make more money than you could by the hour. So keep that in mind while you're building your savings. It's so that money can work for you later. Continue knocking out your line of credits. Get rid of these interest accounts, lower the balances, and writing letters until all the negative stuff on your report is fixed. You want to be at or above 700 for your credit score. Those are the best rates, the best terms, the quickest approvals. Once you get there, it's not everything automatic, but your chances go up, and it's a lot easier once these negative items are gone to rinse and repeat the other, open a new account, lower your balances, get your score to the maximum, and that's how you, in a sense, rebuild your credit. It's time consuming. It doesn't happen overnight. Like I said, it takes a long time to get to that situation, so it's going to take a little while to get out of it. Same thing with the plateau. You'll notice always at one point you'll plateau. That's when you use discernment and figure out a way to boost your score by one of the methods that we talked about earlier. I just put this disclaimer. I'm not a financial advisor, not a financial planner, not a CPA. If you have any problems or questions related to those items, of course, I suggest that you speak to somebody in one of those fields. I can help you with your credit score. I can help you figure out what's wrong and what you could do to possibly fix it. Just remember, there are no guarantees, but I do give my best effort and I use strategies that I've found that worked. So just keep that in mind. Thank you. So that's the end of my slides. So at this point, if you have any questions, like I said,
Oh,
there's my
we
number.
we have
Okay.
questions. First off, would you recommend opening a joint secured account?
I I mean, you can. As far as a joint account, I think it would serve a better purpose if you put it as an account with a primary and then an authorized user. When you go into a joint account, whoever the primary is responsible for the bill, and the joint technically doesn't have to pay it. Same as with the authorized user, in that sense, but a joint account is a lot harder to make go away. Now you have two people reporting the same thing with both of them equally tied to the account. If it's an authorized user, you can take someone on and off at your whim. A joint account, you have to both agree to come off it. So significant other is joint account. They have authorization to order a card, get a card without you even having to approve it because it's a joint. And then they're not even liable for the balances. It's the primary that's liable for the balances. So I think it just could lead to a sticky situation. Somebody be the primary, the other one authorized user. If you ever needed to remove them or get rid of that card, the primary has control. I wouldn't give up the control. Things happen in life. It's not always pretty. So whoever is the primary, no matter what, is going to be liable for the cost. So do what you like, but be smart. Authorized user will give them just as much benefit while putting you in less risk as the primary.
Okay, so Eric is saying he has a student loan that is paid off, but it's still showing in the credit report. How can he update or remove it from the credit report?
That we would do through the inaccuracies I talked about. So once you pay something off, you'll probably notice that they won't call you back or communicate because you already paid them and they technically don't care that it's giving you a problem on your credit report. Those are one of the hardest ones to get off, but it's all about the inaccuracies. I'm guaranteed if you ran your 3B, you would find multiple lines of information that would be inaccurate. It's almost on every account anybody will have. And that's what we would do. We would get them off. I've actually got off a couple last month that were pretty large, like in the five figures. And it's all inaccuracies. You got to find and know what to look for inaccuracies and attack that with the Fair Credit Reporting Act.
Okay, someone else is asking, credit card and banking, she might have gotten her answer. Credit card banking apps give you access to your credit score. Is that the same thing as running your credit report once a month?
No, that's something like Capital One has Credit Wise and Chase has one. They all have different ones they use, but no, that's more of a. They're basically giving you a report from one bureau, right? So TransUnion might do Credit Karma, while Experian does Chase Bank, but they all tie together with one bureau and basically show you a single bureau score. So you're getting a score, and in most cases it's a FICO, but you can't be for sure. You got to actually look to see what they're using in that place, whatever place you're at. Um, but yeah, you're getting an accurate number, just you're not getting all three. You're getting one or the other. You're not getting Experian, TransUnion, and Equifax. And usually when you put in for a loan, especially a house, they're running all three numbers. So it's like a partial view into what you're trying to find out.
Okay, the next one. Do overdue medical bills get reported to the credit bureau? Someone else said no, but We'll ask you. We'll ask you as well.
Well, if they're overdue since 2018, if they're a judgment, if you get a judgment, that won't show up on your credit report, but you could still have a delinquent account that still shows with the lates and charge off. Those are kind of unique. So it depends where you get them from. Some hospitals do their collections in-house, so you actually technically still owe them because it's the original and they have the wet signature contract and you still have a contract with them. But with medical bills, typically they go into a judgment when they go into the courts. And once they're a judgment, judgments don't post as part of your credit report. But like I said, you could still see them as an old delinquent account. After 7 years, if it's not gone, they're supposed to take it off. At that point, you would have to ask them. There is little, I don't want to say tricks, but like in particular with medical bills, when you ask for them to validate, and they'll send you an invoice a lot of the times, and the invoice will usually show medication administered or treatment. And at that point, that's basically like a HIPAA violation because they're sharing your medical information. And that, other than the inaccuracies, that's one way to get it to be removed from your credit report, but you still owe the money. Just because it's not on your credit report doesn't mean that you don't owe the money. And they could come after you. They might send a summons. They might do legal action to come after it. And then you could deal with it and finalize it. But remember, if you do pay things off, make sure you get that pay to delete letter, whether it's medical or credit card. Pay to delete when you're paying a charge off or a collection is big.
Kamish is asking, would my adult child's credit score and history increase if they are an authorized user on my card? And she also wants to know how many children can be added to one credit card account as an authorized user to help build the child's credit.
Well, yes, anybody can become the authorized user and benefit from it as long as the 5 pieces are good. You know, the payment history, number one, utilization, number two. Those are the main things that go month to month. So yeah, as long as you have it on auto pay and you're not going to have any negative late payments that are going to hurt them, and keep that balance at 0 or lower, or at least expect if you have a higher balance one month, the score might drop a little bit. But once you pay it down to 0, it's going to go back up. But when it comes to utilization, just keep that in mind. But and as far as how many, I've never seen anybody do more than 2, but I'm not aware that they have a limit. If it's, I've never seen more than 2 though. I've never had anybody ask that question. This is one of these times where I'm going to learn something because I'm going to find out. But I've
We
never
all
heard of
do
it being
learn
one.
that way, don't we?
Hey, you stop learning,
Yeah.
you stop earning, and
That's
I'm
true.
I'm trying to keep going. So I hope that answers the question though.
Yes, she's thanking us. All right, now Brenda is one of our business advisors, and anyone who's still on the workshop who has a business, listen to this question. She says, would you please discuss the impact of business loan default on personal credit? Thank you.
Okay. Well, that kind of depends. Like sometimes you need your personal credit to get that business loan. And then sometimes if you have built up business credit, you can do it separately by having it just with the LLC. So if you basically got your business loan with yourself as the personal guarantor, it's going to do the same amount of damage that any other delinquent account would do to you. I'm assuming that we're talking about like a small business loan that was defaulted, or maybe a car that's in the business with you as a personal guarantor. It's going to give you the same negative effects as any account would on your personal credit score. The only like the extra problem is now if you are reporting a Duns and Barnes number and you have the D&B, it's going to hurt you there more than your personal credit because they're way more stingy with their points on the business credit side. We're not really here to do business credit. Long and short, it's going to hurt you just as bad as any other delinquency especially while it's fresh or new. Over time, you'll gain points back, but it's going to hurt you just the same as any other delinquency or late on your personal loan. Definitely.
Joe, this was so informative.
This was fun.
This was so well done. You did a
Can,
great
can we do
job.
another one on a similar topic, but
We
something new
will,
another day?
you know, you